Monetary policy. Well, we're first going to review the aggregate demand curve and why it slopes down. First of all, the wealth effect. The wealth effect says that as the price level goes down, real wealth goes up, and if real wealth goes up, consumption's going to go up. Okay, so think of it this way. You've got, from the previous example, when we had $5 in our pocket and a Big Mac was $5, the Big Mac goes down to $2.50, you can now buy 2 Big Macs. Before you could only buy one because the Big Mac was $5. So that's what it's saying here. Real wealth rises with the price level going down, and therefore consumption goes up, and therefore a downward sloping aggregate demand curve makes sense. The next thing was the, or reason, is the interest rate effect. Well, picking up where the wealth effect left off, if the price level goes down, your real wealth goes up, and sure, consumption's going to go up, but also savings will go up. Because just because your wealth goes up with the price level, your real wealth going up, doesn't mean you're going to spend all of it. Your real wealth goes up, you're going to spend some of it. And what do you do with what you don't spend? Well, that's called savings. So savings goes up, and because there's more savings out there, interest rates go down. More savings out there to be lent out will push the price of money, the interest rate, down. And with lower interest rates, that makes capital investment more affordable. More projects have positive net present values, as they say in finance. Returns are higher, so you'll see more investment. And the last one is the exchange rate effect. Well, picking up where the interest rate goes down, okay, from the interest rate effect. Interest rate goes down, investment up, but who's not happy? Okay, investors are happy. When I say investors, I mean capital investors. It's where we have to be careful in finance, in economics. We use the word investment to mean capital investment. And what we typically, commonly in practice or in finance for sure, use the word investment. In economics, we call that savings because we've got to differentiate between the supply of loanable funds from the demand of loanable funds. The suppliers are the savers, the demanders are the investors. So when I buy a stock or a bond, I'm saving, okay? But in common language, everyday language, we'd say we're investing. But so just keep that in mind. So, and every once in a while, I slip up on that. So, interest rate falls. Savers are unhappy with that. And so they're going to want to buy bonds outside the country. If our interest rates go down in the U.S., they're going to say, well, let me buy a bond in France or wherever where the interest rates are higher. So they will sell their dollars. So they put up all these dollars on the market. And what do you have to buy a French bond? You've got to have euros. See, it used to be French francs, but now it's euros. So you're going to have to trade dollars for euros. So there's more dollars on the market. That sends the price of the dollar down. And that makes our goods and services cheaper for foreigners to buy. So because the dollar's cheaper for them to buy, that makes our goods and services cheaper to buy, and net exports will rise. So these aren't competing theories, by the way. These all work the same direction, but not all of them are equal. Okay. The wealth effect is probably the least important because people hold a small portion of their wealth in money. Okay. Money is not the greatest store of value. And so people tend to hold most of their wealth in stocks, bonds, real estate, precious metals or whatever. Okay, and they usually keep only enough money on hand for their day-to-day needs. They pay for the groceries, they pay their rent or their mortgage and that kind of thing. And so that's not going to be a big, enormous factor, the wealth effect. And because international trade represents just a small part of U.S. GDP, the exchange rate effect isn't all that big either. So where all the action is the interest rate effect. And this is what the Federal Reserve Bank is targeting when they're engaging in monetary policy, where they're trying to either stimulate the economy by shifting aggregate demand out to the right, or restraining the economy when they're afraid the economy is growing too fast. You saw in the video, Alan Greenspan first was starting to raise rates. He wanted to slow down that 90s boom because they were afraid of inflation, they were afraid of overheating, and that's where people are saying, come on, Al, this is the new economy. You don't need to slow this down. We can grow faster. And they were right during that period of time. But, once all that new capital investment, all that new technology is in place, well, maybe it can grow faster than it did before. That's certainly possible, but not by huge leaps and bounds the way it was in the 90s. It just, something like that comes along like I said before, the last time something like that really earth-shaking was in the 1920s when electricity was the new amazing thing. Well, so the interest rate effect, let's take a look at how that works, okay? We're going to look at what is called the liquidity preference model. Liquidity preference model looks like this. We put on this axis the interest rate. That is the price of money, okay? And on this, we'll put the quantity of money. Now, the money supply is fixed. It's fixed wherever the Federal Reserve decides they want it. And it is insensitive to whatever the interest rate is. The Federal Reserve has the power to place it where they want, mainly through open market operations where they're buying and selling bonds. So there's our money supply. It's where the Federal Reserve says they want it to be. And here is the demand for money. Well, it slopes down. Now, don't confuse this with, okay, you might say, ho, my demand for money is unlimited. It doesn't matter what the interest rate is, I just want more all the time. Okay, we're not talking about that. We're talking about you have a given amount of assets. You've got stocks, bonds, you've got real estate, you've got precious metals, you've got money, okay? You got savings accounts, you got checking accounts, you've got money market funds, all that. what proportion of your wealth you hold in the form of money does indeed depend on the interest rate. It's influenced by the interest rate. Now, when interest rates are very high, let's say up here, well, let's just write in a number. The amount of money you hold is going to be lower. Why? Because your money's not really earning any interest, or very low interest. And so there's an opportunity cost here. When interest rates are very high, you could be getting high interest rates in bonds. So you're going to do what you can to hold the least amount of money you can, just to get through your day-to-day purchases. However, at very low interest rates, well, the opportunity cost of holding your assets in the form of money is quite low. And so there's a convenience to holding wealth in the form of money. And since the opportunity cost is low, you will hold more than when the opportunity cost is high. Now let's put them together. Here's the money supply. Here's the money demand. Here's the quantity of money. And here's the interest rate. Here's the equilibrium. Okay. At that interest rate, the quantity demanded equals the quantity supplied. So there we go. Money supply and money demand. Now we're going to relate this to the aggregate demand curve. This is how it works. Well, let's put aggregate demand. Let's put aggregate demand over here. This is the price level, and this is quantity or GDP. And we'll put the liquidity preference for money over here. Whoops. I was just testing. Just seeing if you're paying attention. Here we go. Money supply, money demand, interest rate here, and quantity of money there. Okay. So, let's say this is the price level. And the price level rises from P1 to P2. And as a result, we have a collapse of GDP. Okay, so we move along the aggregate demand curve from here to here. So if the price level rises, that means, okay, think of it this way. Your groceries just got more expensive. Okay, let's say you spent $100 a week on your groceries, and now everything's doubled, and now you spend $200 a week because the price level has gone up. Everything's gone up. That means you're going to have to hold more of your wealth in the form of money, right? Just to make the same purchases you did before. So you're going to have to sell some stocks, bonds, and liquidate some whatnot, okay? So the demand for money increases. So before, this was the equilibrium interest rate. Now, this is the equilibrium interest rate. So interest rates have gone up because people are now holding more money in response to the increased price level. So what just happened? We had the price level go up, and as a result, money demand went up, and because of that, interest rates go up, and because of that, capital investment goes down, and being a part of capital investment, being a component of aggregate demand goes down as we move from here to here. So price level goes up, money, okay, let's go through this with my little wand here. Price level goes up, money demand shifts out, interest rates go up, capital investment goes down, aggregate demand goes down. Right there. There you go. Okay, we just saw how a change in the price level will affect the demand for money. Now we're going to look at how changes in the money supply affects aggregate demand. So here's the price level, this GDP or Q, and well, we'll just put aggregate demand there. And over here, we've got money demand and the money supply. Here's the equilibrium interest rate. Okay. Let's say that the money supply, the Federal Reserve decides to increase the money supply. So they go out and they buy a bunch of bonds. The bonds come into the Federal Reserve. Bonds are not part of the money supply. And the Federal Reserve pays for them, these bonds, with money. So the bonds come into the Fed, they're buying them, and they pay for them with money. The money goes out into the economy, and you got more money out there. So money supply shifts out to the right. And as a result, interest rates fall. And with lower interest rates, investment rises, shifting aggregate demand out to the right, investment being one of the components of aggregate demand. So we've got the money supply increasing, we've got interest rates falling, we've got capital investment rising, and capital investment, C plus I plus G plus NX are the components of aggregate demand. Therefore, aggregate demand rises, shifts out to the right. Now, because the money supply is difficult to measure, at least in the short term, we can measure it maybe over quarters and half years, but day to day, it's difficult. So the Federal Reserve usually focuses on interest rates when they are dealing with money supply issues. So they will set up an interest rate target that they're trying to hit. And as mentioned before, that target is usually the federal funds rate. So if, for example, some numbers in here. Let's say the interest rate is 5%, and they want to stimulate the economy. They want things to cruise along a little bit faster, and so they're going to tweak this. They decide to lower that to 4.75%. How would they do that? Well, they would simply go out, buy bonds, until they hit it. Keep buying, keep buying, almost there. Pew. Got it. They'll buy bonds till they hit it, till they've injected enough funds in the banking system that the federal funds rate, which is the rate that banks borrow and lend to each other, that is the rate they're shooting at. This federal funds rate target is reevaluated every 6 weeks when the Federal Open Market Committee meets. They get together and they decide on monetary policy. Is the federal funds rate the way where we want it? Should we tweak it? Should we try to stimulate things a little bit? Should we slow things down a little bit? If they want to tweak it, if they want things to go along a little faster than they are, they will lower that federal funds rate, and they'll increase the money supply by buying bonds. If they think the economy is getting a little overheated and they're worried about inflation, they will raise the federal funds rate target, and they will do that by selling bonds. They will decrease the money supply by selling bonds. The bonds go out in the economy, they suck the money out of the economy in payment for those bonds. So, you often hear on the news that the federal funds rate has been changed. The Federal Reserve has decided to raise the federal funds rate to, 2.25%, whatever. What that means, now the Federal Reserve doesn't have, they don't set that rate. That is not, they set the discount rate, certainly, the rate at which they will lend money to banks. But that federal funds rate is a market rate. But the Federal Reserve is so big and powerful that they can get it to where they want it. So if the Federal Reserve wants that rate to go up, all they have to do is go out there and sell some bonds, reduce the money supply, and that interest rate will rise. But that's what they're watching when they decide how much to shift this money demand curve. So if we go the other way, just a little practice and review. If they go the other direction, here we are. Money supply, money demanded, quantity of money, and the interest rate. Let's suppose that they, here we are, well, let's just say 5%. And the economy is going real fast. Let's say this is the late 90s, and Greenspan is thinking, oh man, we're going to have inflation like crazy as the economy grows at more than 3%, and maybe we're ripping along at 5% growth, and they're nervous that this is going to be inflationary, and we need to rein this in. So we're going to tweak this up to 5.25. And they might do this. That doesn't sound like very much, but usually that's they don't go too far in one shot unless there's like a major emergency, and we'll talk about that in a minute. In fact, but then the next 6 weeks when they meet again, maybe they'll raise it to 5.5. And then 6 weeks later, if they may move it to 5.75. So they'll do it incrementally like that over every 6 weeks when they meet together in the Federal Open Market Committee. But here we are. They want to lower it to 5.25%. Excuse me, raise it to 5.25%. So what do? They simply go out and they sell bonds. They sell bonds, they suck that money into the Fed, out of the economy, and they just keep on shifting this to the left. Money supply, bingo, got it. And then they watch and they see what's happening. They see what's happening to employment and GDP and inflation. They see how it goes. And then the next 6 weeks later, they might tweak it some more, or they might leave it just exactly the same. But that's how they do it. The Federal Reserve watches the stock market very closely in making their decisions. The reason why they watch the stock market is, first of all, when stock prices are high, it creates a wealth effect. We've already talked about that. For stock investors, will increase consumption. Consumption's a component of aggregate demand. Aggregate demand shifts out. Also, a rise in stock prices, well, let's go back. If stock prices are very low, let's say they've fallen, then consumption will go the other way, go down, and aggregate demand will go down. So the Federal Reserve will respond if stock prices are booming or if they're collapsing. They're going to get in the game there to try to stabilize things. A rise in stock prices makes it more attractive to issue new shares of stock for firms. So let's say your stock is $30 a share, but now you've got a boom for now it's $50 a share. Well, you get a lot bigger bang for your buck, right? If you're a firm and you want to issue some shares of stock, that means you're getting $50 a share instead of $30. So that makes that as a pretty good way to raise financing and raise funds for new capital investment. So it'll spur on investment, which increases aggregate demand. So in these cases, the Federal Reserve, if you've got a booming stock market and the new consumption because of high stock prices, people are feeling richer, even though they aren't carrying their wealth in money, in terms of money, they've still got all those stocks and high stock prices, and of course investment. So in that case, as we've said before, they might want to slow things down a little bit, put some restraint, and they might want to shift the money supply to the left and raise rates to kind of slow things down, because when interest rates go up, that's going to slow the stock market. What it does is it makes bonds more attractive now if interest rates are higher. This means people will sell their shares of stock, at least some. Okay, I'm not saying everybody's going to sell their stock, no. But some will sell their stock, some of it, and at least, and buy some bonds. So that's going to put pressure on stock prices to come back down, and bond market, as they buy more bonds. And also, having stock prices fall is going to put a damper on this capital investment, as firms aren't getting as much for their shares of stock as they were before. Now, going the other direction, and that's what Greenspan was trying to do back in the 90s. With this internet boom, it was believed we had a bubble, and we were scared to death it was just going to pop and be a disaster. And then we had a real estate bubble in the early 2000s, and the Federal Reserve is... here's what happened. In the 90s, it turned out to be the correct decision to not really do anything. See, Greenspan and the Federal Reserve started to do this. They started to inch their federal funds rate target up. Everybody howled. Of course, the politicians did, because they want the economy to be booming, right? Everybody wants the economy to be booming. Well, what's he slowing this down for? We've got an election coming up. So there's that aspect. But the debate over that was Greenspan relented. He said, okay, it makes sense. You got this new internet technology. You got these huge shifts in long-run aggregate supply, and we'll watch it very carefully. Okay, and everything was good. Went right up to 2000, and when you got all that excessive investment with Y2K, the issue, it stopped on a dime. When everything turned over to 2000, everything's okay. It stopped, and we had a recession there for a while. But in the late 90s, housing policies were relaxed. They were encouraged, lenders were encouraged, Fannie Mae, Freddie Mac, all those guys were encouraged to buy loans of anybody pretty much who wanted to borrow. They'd buy the loans from the banks, and everybody and anybody was buying houses that they couldn't possibly pay for. But the federal government wanted people to buy houses. So, you know what? Housing prices boomed. Now, here is where the Fed needed to come in and restrain things. But they didn't really do it, not enough. And so there really was a bubble, and when it burst, it really burst. And that's the financial crisis right there. So they get an A in the 90s, they got an F in the 2000s. So here's what, going the other direction, here, and they get an A in the 80s. Okay, let's give them some credit for what happened when the stock market crashed in 1987. 1987. Okay, let's draw little curves again. Money supply, money demand, quantity of money, interest rates. All right. Let's see, the federal funds rate targets were, at the time the stock market crashed in 1987, what happened was the stock market fell. Let's write this down. Stocks fell by 22.6%. This was a huge crash. Now, as I mentioned before, usually when the Federal Reserve starts to tweak things, they do it very slowly, methodically, little by little, 0.25%. And then the next time they meet, 6 weeks, another 0.25%. Okay? Well, when the stock market falls by 22.6%, that's not a time for when to first of all, what do they want to do? Here. How's the stock market going to affect the economy? Here's long run aggregate supply. Let's just have those two. Here's the price level. Here's the equivalent price level. Here's GDP. Okay. Stocks fall. So you're going to see consumption fall, right? People are going to feel poor. They may have the same amount of money in the bank they had before, but hey, their spending habits dependent on, having this big stock portfolio. But now it has collapsed by nearly a fourth. Still going to go out to dinner? Still going to go on that vacation? Still going to buy that car? Probably not. Not right now. Maybe down the road, but not right now. So aggregate demand takes a big plunge. Okay, here's short-run aggregate supply. And we've got that going on. So the Federal Reserve, what they want to do is stop this aggregate demand shift. They want to stop this in its tracks. Okay, they don't want that to happen. So they've got to act quickly. And quickly they did. The federal funds rate was 7.7% when the stock market crashed. That's what it was at the beginning of October 1987. At the end of October 87, it was 6.6. That's a huge change for for the Federal Reserve when they usually dealing in 0.25% every 6 weeks. In a month, within a month, it fell from 7.7 to 6.6. So what did they do? The instant the stock market crashed, they went on a major bond buying program. Boom, really big increases in money supply, injections. And what happened? What was the result? This shift never happened. It simply did not happen. They stopped it before it started. And the economy went on like nothing had happened. Unemployment stayed the same, GDP stayed the same, everything stayed the same. So, quick action by the Federal Reserve. See, that's what they should have done in the 1930s with the Great Depression. This is exactly what they should have done. And they didn't. They didn't do anything. They didn't do a thing. And that's why bank after bank after bank collapsed. That's why the money supply collapsed. Instead, they increased it, and they notified banks also. They told banks that they would have any bank who needed money, they needed liquidity, they would have it. No problems. Contact us, you've got it. Wow. What a difference from the Great Depression. So it was a perfect textbook. Of course, it is in our textbook, but the textbook model of how the Fed should act in a crisis. There it was. Perfection. We talked about why the Federal Reserve Bank watches the stock market closely. Now we'll talk about why stock investors watch the Federal Reserve Bank closely. Well, as we've seen, the Federal Reserve can influence interest rates. And a change in interest rates can change the value of stocks. And here's how. First of all, higher interest rates make bonds more attractive than stocks. If interest rates go up, you're going to be thinking, wow, I can get some good high interest on that bond. I'll sell some of my stocks and buy that bond. Stock prices fall as people buy more bonds. Higher interest rates increase the borrowing costs. So if firms are issuing bonds to raise financing, raise funds for new investment, that makes capital investment more expensive because they have to pay higher interest rate on the bonds. More interest expense lowers profits. Lower profits. If you have lower profits, you're going to, that makes stocks less attractive if you're getting lower profits. So that could lower stock prices. And raising rates can shift, as we said, shift downward, which means investment downward, which means aggregate demand down, which can mean a recession, okay? And certainly when there's a recession, profits fall. And when your profits are falling, that's not the time you want to be owning a company. See, you'd rather have a bond, assuming the company's in good shape, is going to make payments. But owners get part of the profits. And if profits falling, you're not as excited about being an owner. And that's what stockholders are. They're owners of the company. So that's why stock investors are watching every move the Federal Reserve makes. Every time the chair of the Federal Reserve makes a speech, everybody's hanging on every single word, every syllable, every exclamation point, pyramid, question mark, to try to guess what they're going to do. Well, let's call it Fed watching in the investment world. So that's it for monetary policy. It's just a matter of trying to manage aggregate demand via managing the money supply, typically with an interest rate target, usually the federal funds rate.